You're probably losing money right now trying to trade a market that's going nowhere. In my 6 years of trading, I realized that the markets don't really move 80% of the time. They just go sideways, they chop people out, they create emotions, and 20% of the time, they're actually making some of the biggest moves. These are called the quote-unquote fat pitches, and this is where you actually make the most money for the year. Now, the issue is many traders end up trading those great times. They make a lot of money and then they give all their money back the rest of the year by trading the choppy periods. Today, I'm teaching you my stage analysis strategy. This is going to be going over exactly how to know when the markets are going to make big moves, how to capitalize on those moves, and when to stay away from the market when it's going sideways, it's choppy, and it's causing you to lose all your gains. Once you understand this, you'll know exactly when to trade the market and, more importantly, when to sit out so that you don't lose your gains. While most traders take 30 trades on a weekly basis trying to catch every little tiny move in the markets, my goal is to catch the big fat pitches, the trades that I can stay in for maybe a month, 2 months, 3 months, and make me an absolute killing instead of trying to time every little move. And by doing so, I'm up over $200,000 just this month using this strategy and trading the best moves. Let me ask you something. Do you notice how you can nail the direction almost perfectly, but you still end up losing money? You buy thinking that the market is going to go up, and it does. It goes up about 50 cents, but then the next day it's down $1. And then the day after that, it's up $3, and then it's down another $1, and you're just getting whipsawed and chopped out of the position before the real move actually happens. This happens because being right about the direction is really only half the battle. The next one is actually having the right timing. Knowing when to trade is just as important as knowing what to trade. Now think about this like surfing. Imagine you're the best surfer in the world, but you go out and paddle into the ocean when it's completely flat and maybe the season is not so great for surfing and there's no waves. How are you going to be able to trade the market when there is no momentum, when there is no big moves? You're trying to catch something that's not there. Now here's something that blew my mind when I first learned it. Markets don't just move randomly. They actually follow cycles that they've been following for the past 100+ years that tell us exactly when the markets have the best opportunity for big moves. Every stock, every index, every asset goes through the exact 4 stages over and over and over again. Once you can identify exactly which stage the stock and the market is in, you're able to take advantage of those moves by being able to time the market when it's best to be trading, and also sit out of the market when it's starting to go sideways, creating choppiness and making big moves to the downside. Once you can identify which stage a stock and the market is in, you could start to actually know when to get aggressive, when to be cautious, and when to sit completely out of the markets. And this isn't some new strategy that I invented. This is how institutional traders are able to time the market in the highest accuracy. And while retail traders are going around guessing where the market is going to move, having basically the worst timing on when to buy stocks, institutional traders use the stage analysis to know exactly when the right time to buy is. And let me show you exactly what I mean. All right, now this is a chart of the S&P 500 over the last 2 years. And what you'll notice is it doesn't just go straight up and it doesn't go straight down. You have a lot of periods within the market that is called consolidation, where the markets are making their next leg. They're building out a staircase to make that next leg up, whether that be on the upside or even the next leg to the downside if the trend is going to be reversing. Now, you can see we've had multiple periods of times where the markets have had basically no gains. They've gone sideways, they've dropped a little bit, then they came back up until you had a break of that range, which started the next strong leg where you capture most of the gains. Then you have another choppy period right here, and these last for a good amount of time. And if you're able to make sure that you don't trade these when the market is going sideways, you're able to avoid 136 days of pain, of choppiness, of sideways action, and of potentially losing money within that period. Now you can see right here, we had another choppy consolidation before the next leg up. Then we had another choppy phase right here where we made a new low and then we consolidated under the high until we made the next leg up. And then right here, we had another choppy phase. So you can see in just 1 year, there was about 1, 2, 3, 4 very choppy phases within the market that all lasted about 2 to 3 months that you could have completely avoided and traded the rest of the upside potential or even the downside potential when the big moves were being made. The same thing right here. You had a lot of choppiness. There really wasn't a lot of progress within the market. It wasn't able to break to the upside, and then it broke to the downside, making a quick move, which was the tradable move. Then it started to consolidate again, and then it broke out of the consolidation, started to trend back to the upside, and since then has been making very strong moves up. But even though it's been making strong moves up, it still hasn't been just straight up. There's been consolidation periods where the market has gone sideways, set up for the next leg up. It's gone sideways and it's set up for the next leg up. And now we're probably going to see another consolidation phase as the market starts to slow down. This is because markets cannot go straight up. This is called the staircase pattern. Stocks go up, they go sideways, and then they make the next leg up. Or if they're downtrending, they make a strong move to the downside, they go sideways, and then they make the continuation down. And this is how you're able to catch the markets whenever they start to be making really big moves. And this is how you can catch the strongest moves in the market. Now, every market cycle has exactly 4 stages. Understanding these is like the roadmap of when to trade and when to get aggressive and not to trade in the markets. Your stage 1 is going to be your accumulation phase. This is when the market starts to bottom. This is usually coming after a big drawdown and a big move to the downside, kind of similar to what we had in April, kind of similar to what we had in 2022, and kind of similar for something that we had during COVID. When you have the big corrections and the market starts to accumulate and build the bottom, it comes from retail capitulating and getting out of their positions after the sentiment becomes the worst that it's been. Everybody is fearful. Everybody thinks the markets are going to crash. And this is when panic sets in. Everybody sells, but institutions under the hood are actually buying these stocks from the weak hands. And the transfer is going from the patient, which is the institutions, from the impatient trader, which is the retail trader. Now, during this stage, you still don't want to be trading because accumulation means that the market is still going sideways. So you don't know when that accumulation period is going to end until you have a break of that structure, which starts our stage 2. Now, stage 2 is called the markup stage, and this is actually where all the money is made. When the market starts to break out of its stage 1 base, accumulation base, now you know you're in the strongest period of the market, and this is when you want to be trading in the markets. Now, this is the only stage where I'm aggressively buying and longing stocks because this is where a ton of the money is made. Then comes stage 3. This is called the distribution phase, and it's very similar to accumulation, just the other way. This is usually going to mark a significant top where stocks start to go sideways, they start to sell off, you're going to have lower highs being made, and then you'll break that distribution base and start a strong downtrend. Out of that downtrend, you're going to have your stage 4, which is going to be the opposite of the stage 2. It's going to be a strong move, but to the downside. This is where you'll have most of your selling. You'll have massive selling pressure. And then guess what happens after a stage 4? You start entering another stage 1 after all the selling, panic, and everything and all the emotions kind of settle down. Now, here's the key. Stage 1 and 3 are going to be your consolidation phases. This is when you want to be kind of avoiding the markets because everything is going sideways. There's not a lot of gains to be made because there's defined highs and defined lows where the market is just ranging instead of making big moves. Stage 2 and stage 4 is where the really big moves are going to happen. If you're going to look to long stocks and play the upside, you want to be longing stocks in a stage 2 markup. That is where the biggest upside moves are going to happen. Now, if you're looking to short stocks, you also want to short stocks or play the downside after the stage 4 decline begins and the market starts to break out of that stage 3 base to the downside. All right, now here's a clear example of a stage 1, 2, 3, and 4 cycle that a stock has been in. So this is the ticker ARK on the 1 week time frame, and you can see right here this stock was entering a stage 1 consolidation phase. You have almost no new highs being made, no new lows, and market is just going sideways until you have the spring and the markup phase, which is going to be your stage 2. So right here is going to be our stage 1 base, our stage 2, and then guess what happens right here? You have the stage 3 consolidation again, which leads to the big move to the downside, on this stage 4 right here. So 3 and then 4. And then guess what happens right here? You start to build your second stage 1 base like so, and then you start entering the stage 2 move, which should continue to make big moves up to the upside. And this cycle continues to remain as long as obviously the company on the stock is in the market. Now, knowing this, we know exactly when to trade. So we want to be avoiding trading the stock whenever it's in that stage 1, but we want to be in it as it's breaking out into that big stage 2 rally. Now up here, we want to be looking to potentially short the stock or play the downside as it breaks out of its stage 3 base. Now here's an example of actually one of my biggest winners ever on the ticker Robinhood, and the reason why this worked so well is because I was able to identify the stages of the market that this stock was in and was able to catch a massive move on this stock. So this stock IPO'd right here, and keep in mind the stock doesn't have to start on a stage 1. If it IPOs, it can go straight from a stage 3 to a stage 4, and you could see right here was clearly your stage 4 decline. Stage 3 was right here. So stage 3, stage 4, and then you started to build your stage 1 base right here. Now during this time, I wasn't trading or looking to trade the stock because it was just going sideways and there wasn't really anything to do on this stock. But once it started to break out of its base, and notice how the volume increases as the stock breaks out, this is when it started its massive run up into stage 2. And potentially now it could be starting a stage 3. It might be too early to tell. And again, keep in mind, this takes a lot of time for these moves to play out. This doesn't just happen in a day, 2 days, 3 days. This might even happen over years. Right here, you could see you have a base from 2022 all the way to 2024, which is 2 years of consolidation. You wait for the breakout of that stage 1 base, and then you're able to get the big stage 2 breakout. Now here's another example of a massive winner that I had over the last 2 years. This is on the ticker RKLB, and you can see it IPOs right here straight into a stage 3, and it starts to go sideways. It doesn't really make any big moves right here, and then it drops lower, stage 4, until it builds a massive stage 1 base like so. And keep in mind, of course, you want to be looking for some of the strongest stocks in the market with the best themes. This was a super strong stock in the aerospace and defense theme, which was a leader within that theme, and it emerged out of the base, creating an absolutely massive move. So this is going to be your stage 1, and then it enters your massive stage 2 rally, which is where you want to be looking to long the stock, and it moves over 600% within that period. Now, of course, now it could be starting to develop your stage 3. You don't want to be looking to trade stage 2 stocks as they get way too extended from the weekly moving averages. So you can see you have the weekly 21, 50 all below. You want to be trading these near the weekly moving averages. Once they start to get extended like this, probably going to be entering that parabolic cycle, which leads us to a potential stage 3 and then stage 4 decline until the cycle repeats itself. Now let's start with the most important skill, knowing when not to trade. Consolidation happens in stage 1 and in stage 3. The market is basically acting like a spring. It's going sideways, it's building energy and momentum until that base breaks and you have the massive explosion. Now here's how we're going to spot consolidation. This is when the market is going to start to become slower. You're going to see volatility dry up, and you're going to have a defined base where the market is building out a leg, meaning you're not going to get any new highs and you're not probably going to get any new lows with any big moves until the break of that base is made. Now, most traders will see this and they'll try to catch small trades within that base. They'll try to guess where it's going to go, where it's going to move, and they're not really going to make any big progress, even if they win on a lot of those trades, because they're so small, because there's not a lot of volatility. And this is exactly wrong. This is the worst time to be trading. You want to be trading when there's volatility, when there's asymmetrical risk, and when there's a lot of great opportunities for big moves within the market so that you can make massive, massive gains on the fat pitches. When the market is consolidating, you should be consolidating your capital, watching, preparing, and getting ready for the next big move. Here's an example of a stock going through a consolidation phase when it's trying to set up for its next leg up. You could see you had the really big move up, which was a 114% move, and then the stock starts to pull back slowly 25% and consolidate. You're seeing the volatility is dying off. You're not getting any really big moves up, and you're not really getting any big moves down. You're kind of just getting a coiled spring that looks something like this. This is how you start to know that you're in consolidation. There's no new highs and there's really no new lows. It's just kind of consolidating within this range. And you could see, you could be trying to trade this range and maybe making a few percentages as the stock bounces off the lows, get maybe a 15% move. And then when it comes off the high, you can get another 15% move. But the real pitch was when the stock broke out of that consolidation. You could see right here when it broke out, you caught a 121% move, and you only had to be right once. You didn't have to be right multiple times as the stock consolidated and guess exactly where it was going to go. Bought it right as it was breaking the big base, and then caught that really big move by just sitting in the stock and letting the stock work. Now you can see we had something very similar right here as well, where we had no new lows being made, no new highs being made, and then right here the spring got so coiled that it ended up exploding out of the base with a ton of volume and starting to make that really big move up. This is how stocks move. They'll move in big moves like this. They'll go sideways, and your goal is to try to avoid trading them as they go sideways, but be prepared for the next leg up, because this stock, if it starts to break out of this trend line, if it starts to make new highs, it might be ready for that next leg up, and you can catch that burst as it breaks through this big base. On this ticker, you could see the exact same thing play out. It has a tight base right here off the lows. It's not really making any new highs or any new lows. And then it starts to break out of that base with a big gap up on volume. And then boom, the big move is made, 164%. Then it starts to consolidate again as it pulls in like so. It goes sideways here. You can see the volatility right here starts to die off. There's not really a lot of big moves happening to the downside, not really a lot of big moves happening to the upside, until it's able to finally kind of break out of its range, break through these highs right here, and then start that new really strong leg up, which you could see ends up being another 119% move. Now it's doing the same exact thing it was doing here, because this is how stocks move. They move within these cycles. Sometimes they'll go sideways, sometimes they'll pull back a little bit deeper. This one right here, you could see, is trying to build its next kind of leg up like so, but it still needs more time. You can see it's not making any new lows, not making any new highs. It's kind of compressing and building that spring. This is how we know to try to avoid this stock until it finally breaks out of that range and starts to make new highs and push out of this range. Now, you can also trade this one to the downside. We don't only trade big bases to the upside. If this is going to be a stage 3 top and it's going to build it out over the next few months or days, if it builds out that base and it starts to break to the downside like this, you can look for a downside move, because you're going to get a very quick move once it breaks those key levels. Now, let's talk about stage 1 specifically. This is going to be our accumulation phase. This is where smart money is building positions while everybody else is really scared. After the stock has been falling for weeks, months, and maybe even years, the stock finally stops making new lows and it starts going sideways and building a massive base. Now, the most important thing is what you'll start noticing within these accumulation bases is the volume pattern. So volume will start actually going up as the stock is being bought, and on the down days, the volume will decrease, showing less institutional selling. The volume difference is going to be institutions starting to buy. They're absorbing all the selling from retail, money switching from weak hands into strong hands, and you start to see the chart patterns forming on the bigger time frames. Now, keep in mind, the accumulation phase can last for 10, 20, maybe even 50 years. I've seen stocks that have been going sideways for literally the last 50 years, and this is why it's hard to trade within that time frame, because you could be owning that stock for 50 years and make literally zero gains because you're trading it in the wrong time. This is why, instead of trying to time the bottom, I prefer to wait for the stage 1 to fully play out and then transition into that stage 2, because that's actually where the biggest moves are going to be made. So sure, maybe I'll miss a few percentages on the stock as it's consolidating, but most of the gains are made anyways after the stock starts to break out, and that is when the timing is correct. So what I'm missing with the few percentage gains on the lows, I'm making up with the opportunity cost of buying these stocks once they actually start to move, and not when they're going sideways. So here you can see a stock that's in a stage 1 base setting up to make that stage 2 markup. Now, what you're seeing here is exactly why volume patterns are so important. We're on the monthly chart on the ticker lift, and you could see it came off of a massive stage 4 drawdown, and then it started its stage 1 base off the lows right here. Now you can see on the beginning, of the stage 1 base. It was kind of starting to make lows very, very slowly, but it failed to make new lows. Then it made higher lows, higher lows, higher lows, and started to really get tight within the base. And even though it was going sideways, it was quietly being absorbed by institutions, and you could see that within the volume. So on the left side of the chart, when the stock was making a massive move to the downside, you could see the volume was super high. Now, this was institutions starting to absorb a lot of the selling and capitulation taking place within retail. So left side of the chart, as the stock makes the left side of the base, you see a ton of volume. And what ends up happening is the volume will dry off for a small period of time because buyers are, institutional buyers are taking time to develop this position. Then you'll start noticing that the volume patterns start to switch. So every time the stock has an up month or an up day or an up week, the volume is going to be super high on the buy side. Right here, it's super high on the buy side. Few times you're going to have sell side volume, but overall you can see the patterns are on the buy side. And if you draw a line like so at the peak of the volume, you'll start to notice that on the right side here, now it's all volume that's coming from the buy side. So the big volume bars are all going to be your green bars, and on the left side it was all really the red bars. There was really no big green volume yet. And then you can see the volume patterns continue to stick, and even though recently it tried to break out right here, volume was on the upside, showing you that institutions are really piling into this stock. Now, this is going to be your resistance level where the stock needs to break for the stage 2 to start. So you can see it's right at that spot right here. It's getting ready to break out. And if you go down to even the weekly time frame, you can start to notice that this stock is really setting up to finally make that move and push out of this big stage 1 base into a stage 2 markup. Now, here's another great example of a stage 1 base that is now playing out into a stage 2 markup. You can see this stock came after a big downtrend to the downside on the stage 4 right here, and it started to build that stage 1 base. Now, again, notice the left side of the chart is going to have a ton of sell volume on the downside. This is retail starting to capitulate. Volume starts to dry off a little bit, and then guess what ends up happening? The big institutions, they start to accumulate this stock, and you can see the volume patterns are all to the buy side. Again, if you draw a line like so at the highs and the average highs of the volume, you'll notice that they're all from the buy side like so. And then the stock starts to break out, volume continues to remain super high. And what you also want to see is sometimes the stock will retest the stage 1 breakout like so, and then it will continue its next leg up, exactly like this stock did right here. And you caught a 124% move, while the stock over the last 2-3 years here, the biggest move was a 120% move off the low. And overall, from the breakout, you caught a 236% move on this really big breakout. And this one's likely to continue to go higher. So you'll probably catch another 40, 50, 100% as long as you stay and trade this stock. And you can see the cleanest moves are happening as the stock is in that stage 2 markup. Now, this is where the magic happens, that transition from the stage 1 into the stage 2 breakout. And this is where all the money is going to be made. When a stock breaks out of its accumulation, it's violent. These are when the 20, 30, 50% days are possible on the stock. Volume will end up exploding as well. Sometimes you have as high as 5 to 10x the average volume, and you get massive moves and the stock never looks back. Once you're in stage 2, this is where you make your money. You want to be looking to buy every single dip into the moving averages that sets up. You want to be looking to raise your stops, hold your winners, and be able to catch those really big moves in the market. Now, keep in mind, this trend can last for weeks, months, and even years. So make sure to be able to be positioned well in these names to hold them for a long period of time to maximize your gains. This is an example of some of my favorite recent stage 2 breakouts that occurred that I was able to personally trade. This was the ticker EOSC that was coming off of a massive stage 4 decline. It started to build its stage 1 base right here, set up under these lows, build a super tight base. You can see the volume start to come in on the buy side, and boom, right as the stock starts to break out of the stage 1 base, volume absolutely explodes. Now, this is going to be your entry spot. You want to be looking at the stock when it starts to break out of the stage 1 base high. So right as it's breaking this level right here, you can look for that big continuation to the upside. And notice what ends up happening when the stock starts to enter a stage 2 is the moving averages just start acting as beautiful support every single time they get tapped on almost every time frame. On the bigger time frames, of course, you have a big reaction off that spot. So right here, you can see this is the weekly AEMA being tapped. Beautiful reaction, and then you're getting the continuation to the upside. Now, this is how the daily time frame looks. You could see this stock ends up breaking out over this level right here, and it starts this big uptrend here. Look at how it's holding the moving averages. Every single time it taps the AEMA, makes a new high. Taps the AEMA, makes a new high. Obviously, at some point, it does need the bigger moving averages like the 21 and the 50 to start coming up, but the moving averages just continue to act as support in this big stage 1 breakout. This is another trade that I took on the ticker Palantir. It allowed me to buy the stock at $10, and the stock is now trading at over $180, making for an 18x on just shares of this stock. Now, you can see this stock actually went through exactly what we're talking about. It started with a small stage 1, stage 2 markup right here. This was the stage 3, and then boom, you had the stage 4 decline, and it started to build this massive stage 1 base on the weekly chart. Now, notice what ends up happening to the volume patterns as the stock starts to build the stage 1 base. The volume starts to come from the buy side, and then as the stock breaks out, look at what happens to the volume. It just absolutely explodes, and you get a massive move out of this base. Now, you don't only have to buy the stock when it's breaking out of the stage 1 base. You could actually trade it as long as it's in a stage 2 markup anytime it sets up a continuation setup, because what happens a lot of times is the stock doesn't just go straight up. It might pull back, it'll set up another base, and then it will make a continuation leg that you're actually able to trade. So there was many times you could have looked to get into this stock when it was setting up. So for example, right here, as the stock set up in this space, catch this move. As the stock broke out of this space, catch this move, catch the retest, look for that big continuation to the upside. But of course, the best time to buy would be to position yourself as the stock is breaking out of the base. But every party has to end, and this is where traders lose the most money. They don't recognize that the stock is starting to enter a stage 3 consolidation phase, which ends up being the stage 4 markup phase later down the line when the market is distributing off the highs. Stage 3 looks exactly like a stage 1. You have consolidation, you have the markets going sideways, and it looks like everything is going to continue to go up. But what's the massive difference? Well, the difference is everybody thinks the market is going to go up. Everybody is euphoric. Everybody thinks that things are going to continue higher. And in stage 1, notice how nobody wants to buy. This is where accumulation is happening, because buy when others are fearful and sell when others are greedy. This is how the market moves. When everybody is greedy and when everyone thinks that the markets are going to go higher, that's actually when the best time to start looking to sell is, or to start look for that distribution to be occurring. When the market is panicking and everyone is panicking and you had a massive move to the downside already and everybody is looking to sell now, that is the good time to start to potentially looking to accumulate and for the market to set up in those big stages. The signs are subtle, but they're clear. What ends up happening in the stage 3 is the stock starts to fail to make new highs. And if it makes new highs, it fails to break out higher. It comes straight back into the base. Now you have consolidation that's happening on the lower part of the base. So it tests support more times. Every time it bounces, it starts bouncing less. The moving averages are now starting to cross the other way, and you're starting to see the momentum fade out of the market. Now, this is distribution. Smart money is selling to retail traders that think that the stock is going to continue to go high. Here's an example of a stock that could potentially be in a topping distribution phase. You could see this stock right here ends up making a massive stage 1 base. It starts the big stage 2 markup, and then it starts to get very extended. Now, everyone thinks that this stock is going to continue to go higher here, but what is actually happening under the hood? Well, it starts to set up within the space, which starts to look like a good continuation, but it breaks lower. And then you can see the volume starts to come from the sell side, and the candles on the volume are leaning towards a sell-off. Now, going on the daily time frame, we could see the warning signs a little bit clearer as well. You could see the volume is all on the sell side. Every single time the stock tries to go higher, it gets swatted down immediately with high volume. Now, another thing is look at the price action. Look at how well the stock was trading here. It was holding the moving averages. It held to 21. It continued to move higher. But right here, look at how loose the price action is. You have kind of choppy movements. The market's not really holding the moving averages. It's under the moving averages here. It's failing to make new highs. And that tells you that there's signs. Doesn't necessarily mean that this stock has to go down, but the signs are clear. And if you could look at the signs, if you can notice the signs, that is where you're able to understand, okay, the market here is starting to potentially build that stage 3 base. When stage 4 begins, it's absolutely brutal. The move is just as violent as when the stock is breaking out of its accumulation base into a markup phase, but it's doing the exact opposite and moving to the downside. The stock breaks below support, it starts to accelerate to the downside, volume continues to explode, and you have big moves to the downside. Everybody that bought in the stage 3 thinking the stock would go higher is now underwater, and panic selling is beginning. This is where you have two choices. If you're long, get out of the stock, no second guessing, don't pray and hope that the stock goes back higher. If you're a short seller and you're looking to play the downside, this is where your opportunity is. The key is recognizing the transition early. By the time it's so obvious, everybody is already late. Now, this is a great example on the ticker LMND in 2021 when it flipped from its stage 2 to stage 3 and then going into a massive stage 4 decline. How to start spotting these. So what you start to notice is the stock starts to make a massive move to the upside. Of course, we know that that's going to be your stage 2 markup. Now, from there, you start to notice that it stops making new highs. You can see every single time it tries to get up here and make new highs, it actually fails and leaves over these long wicks. And the next big clue is going to be the volume. You start noticing that the volume is actually high as the stock goes up, and then out of nowhere, it starts to get sold off, and the volume is actually high now as the stock is going lower. So it's kind of the complete opposite of our stage 1 into stage 2 transition, looking for high volume as the stock starts to sell off. So right here, you have a failed breakout to the upside. You actually break the low of the base with a ton of volume, and then your stage 4 decline. You actually break the lows of the base with a ton of volume, and then your stage 4 decline starts. So how do you actually trade using stage analysis? First, every weekend, start pulling up the weekly and daily charts on the markets and start to look at what the market is doing. Is it just now breaking out of a base? Is it starting to consolidate? Where is it in relation to the moving averages? And what is the big play that we could potentially be looking at? If the market is starting to break out of a big base and it's entering a potential stage 2 cycle, then now you're going to be looking for stocks that are moving from stage 1 into stage 2, and you're looking to be aggressive to the long side. If we're in stage 3 going into potentially a stage 4 and the market starts to break out off of the highs to the downside, now you're looking for potential shorts, or you're looking to completely avoid trading the market, especially on the long side. If we're in a stage 1 or if we're in a stage 3 and you're just seeing consolidation over and over and over again, you want to be patient. Cash is a position. All right, so now we want to put these all together. So what we'll do is we'll start looking at the daily and weekly timeframes of the major market indexes. So to start, I always like to look at QQQ, which is the NASDAQ, because I mainly trade tech stocks. So if I'm looking to trade a tech stock, I want to know what part of the cycle the market is in. So it looks like the market has just kind of pulled back off of the highs, and now it looks like it's potentially starting a consolidation phase. The volume patterns are telling me that there is a mix of a ton of selling and then some buying here near the lows, which basically means the market is pretty much on the neutral side. We did hold the key moving averages, so it does look like we could see some more support near these highs right here, and obviously a lot of resistance near the highs. Now, what this sets up for is potentially just some chop. And I can start to identify this by just looking at the overall price action that we've seen over the last few weeks. It looks like we've had a lot of consolidation here, a lot of quick move here, and then a quick move back down. And it just seems like the market might need a little bit more time to potentially set up for a stage 3 or a continuation setup for the upside. Going on the weekly, we can kind of see the same exact thing. We had almost no consolidation since making this big run up, so it does seem like another consolidation phase is potentially likely until we get a bigger move higher or a stage 3 top starts to develop. The volume patterns aren't really so kind of telling yet. You don't see a ton of sell volume yet. It just kind of looks mixed, and when it's mixed like this usually just tells me the market wants to consolidate until it picks a direction later on and the volume patterns are a little bit clearer. Now, the reason why it's so important to scan through the different sectors and kind of find which sector is breaking out and which is not is because you can actually see that even though the major indexes like the NASDAQ and the S&P are kind of near their highs, something like an ARK, which kind of follows some of the growth stocks, is still in its stage 2 breakout. So knowing that's in a stage 2 breakout, we actually want to be looking to buy the pullbacks on this kind of index. So noticing that ARK is in a stage 2 kind of base here, it's retesting the previous breakout. This would actually be an interesting spot to start looking to potentially buy it. You could see right here we had a little bit of a breakdown. We broke under the moving averages. This could be a key spot to watch. Now this could completely be a massive base that sets up for lower, and this is actually a stage 2 failed breakout, which does happen of course, but overall it does seem more likely that this will bounce here, set up for the next leg higher, because the bigger time frames on this, when you look at the monthly, when you look at the weekly, are clearly indicating a stage 2 breakout. And keep in mind, markets still do not move straight up and they don't move straight down. Even when they're in these strong stages, they still need to retest into the moving averages. They still give you some pullbacks that are tradable to potentially look to take the next leg higher. Now here's my number one rule that saved me hundreds of thousands of dollars. If the market is stuck in a less than a 6 to 7% range for the last 2 to 3 weeks, I try to avoid trading. I don't care how good the setups look. I don't care if my indicators are screaming buy off of key levels. The markets are clearly not in a good environment to trade, and all that's been happening to me is I've been losing money trying to trade the markets. So why would I do that? Why would I throw money away in the bad conditions? And even if you're right about the direction of the move, you're not going to have enough follow through because the market is chopping. It's not making any big moves up and it's not making any big moves down, meaning your risk to reward is not going to make sense. You might get at best a 1 to 2 risk to reward or a 1 to 1 risk to reward, whereas we're looking for a 1 to 5 or a 1 to 10 and continuation for these big moves to play out, which is where the big money is made. The chop is designed to frustrate you. It's designed to make you emotional. It's designed to make you overtrade and let your account bleed out. Just make sure you do not let it do that. If you want to see me identifying these stages in real time, and if you want to know exactly when I'm personally taking a trade and when I'm sitting out of the markets, I do these 3 times a week in my inner circle. We analyze every single major market together. We find the stocks that are ready to break up or break to the downside. And most importantly, we develop the discipline to stay out of the markets when there's no big moves that is happening. If you're serious about becoming consistently profitable in the markets, there is a link down below to apply to join the inner circle. That was it for the video. I hope you enjoyed this one. Smash the like button if you want more videos like this, and I'll see you in the next one.